Welcome back to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us, welcome to the show. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. It is the fourth episode in our four-part series on index ETFs.
Yeah.
If you didn't think there was a lot to talk about when it came to index ETFs, well, hopefully we've proven you wrong.
Yeah.
Because as you may have noticed, we're fans of the products.
We are, despite their growing popularity. We think ETFs still have a bigger role to play as we grow wealth over the long term.
Yeah, now this series is an educational collaboration between iShares by BlackRock, S&P Dow Jones Indices, and Nabtrade.
If you're looking to invest in iShares ETFs, but you're not sure where to get started, visit blackrock.com.au/iShares for information about their ETF range, or visit nabtrade.com.au to explore further insights, education, and tips for getting started with ETFs.
Now, in this final episode of our Index ETF series, we're going to be looking at why indexes are designed to be timeless, and they represent perhaps the only truly timeless investment option.
Yes.
It's a big call. It's a big call.
It is a big call, but we love big calls.
And so we're going to start by bringing out something we wrote about in our second book, Don't Stress, Just Invest, which was all about index ETFs.
Yeah.
So if you haven't had enough after this series, that's the thing to go and read. That we coined the phrase, companies die, but indexes are forever.
Yeah.
So we're going to bring that out and explain why that is the case. And then we're going to talk about what that means for us as investors when it comes to investing for the long term. But Bryce, let's start with what has become one of our favorite sayings here. Companies die, indexes are forever.
Yet to get a tattoo, but maybe one day in the future. But yes, let's start with the first component of that. Companies die.
Yeah.
What do we mean by that? Pretty grim.
Yeah, well, I mean, it's true. So Jeffrey West, in his book Scale, calculated that since 1950, 28,853 companies have traded on the US stock market.
Wow.
Of that, 22,469 had gone bankrupt by 2009. That is 78% of companies that had traded between 1950 and 2009 going bankrupt.
Wow.
78%.
Wow.
Just like stop and reflect on that.
Don't go into business.
If we apply that to the ASX 200, that would be saying at about 150 of the ASX 200 companies go bankrupt in a 60-year period.
Yeah.
Like it is
wild.
Yeah, it's pretty amazing. So that's the first part of it. Companies die.
Yeah. So we can tick that. The second part, indexes are forever. What does West say about that?
Well, even though 78% of companies listed on the US stock market between 1950 and 2009 went bankrupt, the US stock market as a whole, the index, grew 23,249% in that time.
Wow.
Or put another way, each $100 invested with dividends reinvested over that time period turned into more than $200,000.
Wow. Well, I'm a little bit confused though, because I'm sitting here, we're saying on one hand, companies die, 78% of companies over that period went bankrupt.
Mm-hmm.
But on the other hand, you're saying that the index has pumped out incredible returns.
Yeah.
How do we reconcile those two numbers?
Yes. Well, if you think about the economy and just business in general, it is constantly pushed forward by new companies innovating with new technology, new business models, new ways of satisfying our wants and needs. And companies that were driving the economy forward, they get smaller and they die and they get disrupted by new companies. You know, Maya and DJs were how our parents went shopping, and they are now struggling, and it's, you know, the Amazons and the Shopifys of the world that are picking up the mantle and running with it. And at some point they will get disrupted by the next iteration of consumer preferences when it comes to shopping. And in every industry, you know, Blockbuster was massive, Netflix disrupted it. Like you can think of all these examples in our life of how companies are dying and then the economy is pushed forward by new entrants and new technologies and new companies. It works the same on the stock market with stock market indexes. As companies die, or as they get smaller, they make up a smaller and smaller part of the index. That's what we covered in the last episode. And these new companies that are getting bigger and growing, they make up bigger and bigger parts of the index. And that's, in essence, how you reconcile those two numbers. But I think we can probably illustrate it with an example.
So let's look at 3 big companies, Ren. We've got IBM, General Electric or GE, and Apple.
Yeah.
And let's use those as an example to illustrate.
3 companies most people are probably familiar with, or at least have heard of.
Yeah. And 3 companies that were each the largest in the S&P 500 or IVV in their day. So IBM was the biggest American company in 1980. GE was the biggest American company in 2000, and Apple was the biggest company in 2020 and oscillates to and fro at the moment with some of the others.
Well, Nvidia jumped it, but Microsoft I think is.
Yeah.
Now, like these companies, like it's impossible to describe how dominant these companies were back in their day. But I'm going to try anyway. So in the 1980s, there was a saying in the stock market, no one gets fired buying IBM. It was like the safe, if you're a professional investor and you just, you want to get good returns, you buy IBM.
Yeah.
I mean, it's kind of like the big tech companies too.
Yeah.
But that was the saying. No one gets fired buying IBM. Then General Electric was so dominant in its period with Jack Welch as the CEO. He wasn't the first celebrity CEO. I think that goes to Lee Iacocca, the Chrysler CEO. But like Jack Welch was the celebrity CEO. Like, and his management principles, what is it, like Six Sigma or something? It just like informed a generation of MBA students and management consultants and the rest. Like General Electric was so dominant. And again, it was such a big part of everyone's portfolio.
Yeah.
And Apple, we know how dominant it is and we know how successful it has been. Like these companies were giants in their day.
I remember, this is a side note, but I remember when I was in school in Wagga Wagga, they took us to Sydney for a General Electric day where they just had halls of prezos by people from General Electric pumping up their business, being like, come and work for us. These are all the possibilities. And
how old would you have been?
I remember leaving, it would have been around 2000, like early high school.
No, you weren't in high school in 2000.
No, 2002, 2003. Probably as they were on their way out.
Okay, like 2000,
Yeah, well, I graduated 2009, so when's that? 2003. When would have started? Yeah, I remember it was like year 7 to year 8, and they took, and it was like General Electric days, and all of the divisions, General Electric, Division 1. I can't remember the divisions. Anyway,
like healthcare, aerospace,
everything,
electricity and power generation.
Electricity. I remember the electricity one. Yeah, everyone was just there drinking the Kool-Aid.
Okay,
it was phenomenal.
All right, well, anyway, that has nothing to do with what we're talking
No,
about.
but it's just a side note. A bit of personal life.
Interesting that GE swung that with the Wagga High. So
well, it wasn't just for Wagga High. It was like
interesting that they swung that with the New South Wales Department of Education.
Yeah. It was like a big promo day.
Yeah. So getting back to the index, in 1980, IBM was number 1. GE was 8th in the S&P 500, and then Apple wasn't even a listed company yet. It was founded in 1976, and it only listed on the stock market at the end of 1980. Fast forward 20 years, General Electric is number 1. IBM has drifted to number 11 on the index. Apple, 134th in the S&P 500.
Yeah.
It's coming, but it's a long way off.
Yeah.
But 20 years later, Apple is number 1, biggest company in the S&P 500. IBM has fallen to 53. And in 20 years, General Electric has fallen from top spot to 63rd in the index.
Yeah.
The winners get bigger, the losers get smaller. This is leading to what makes it timeless.
Yeah, well, there's no doubt that if you'd invested in these companies, you would have done well. If you'd invested 1,000 in IBM at the start of 1980, in the 40 years since, you'd be up 400%. So turning that 1,000 into $5,000. However, if you'd invested the $1,000 in the S&P 500 at the start of 1980 and benefited from the change in companies as IBM got smaller, Apple started to get a little bit bigger, that $1,000 would be worth more than $130,000 today. So that's a return of over 13,000%.
So rather than buying the biggest company in 1980, if you'd bought the index as a whole, rather than getting 400% return, you would have got 13,000% return.
Yeah.
The same story plays out if you look at 2000. If you had invested in the biggest company then, General Electric, $1,000 into them at the start of 2000, today you'd have $200 left.
Yeah, nothing. Yeah.
The stock's fallen 80% in the past 24 years.
Yeah.
But if you had invested $1,000 in the S&P 500 at the start of 2000, today you would have $2,700. You would have almost tripled your money in that 20-year period. So it's just a reminder that the way indexes are designed to give you more of the good and less of the bad with no fixed end date. That's the really important thing. There's no end date to their construction, just every quarter they rebalance. It makes it a truly timeless investing product because in theory, you can quarterly rebalance forever.
Yeah. How good. Now we just want to say a big thank you to iShares by BlackRock, S&P Dow Jones and Nabtrade for supporting this series on the elegance of ETFs.
If you're feeling overwhelmed with what to invest in and which companies to pick is a source of stress, don't worry, we've all been there. With iShares S&P 500 ETFs like IOZ, IVV and IOO, you can get low-cost access to hundreds of the world's largest companies in a single trade to help diversify your portfolio and reduce the stress.
S&P Dow Jones Indices does not sponsor, endorse, sell or promote any product based on an S&P Dow Jones index, nor does it make any representation regarding the advisability of investing in the products. Before making any investment decisions, you should assess whether the product or service is appropriate for you and read the PDS and TMD available at blackrock.com.au.
So we've discussed how these products are timeless, but let's now talk about what that allows us to do as investors and how that can affect, I guess, our investing behavior and decisions as we just try and build some wealth in our lives.
So the first thing it allows us to do is dollar cost average, which essentially means take the same amount of money and invest it into the index at a consistent interval.
Yes.
Take $100 every fortnight, put it into IVV or IOZ, and that's all I need to do.
Yeah. I'm sure people who have been long-time listeners of Equity Mates have heard us speak about dollar cost averaging enough, but we would argue you can never speak about it enough.
That's it. That's why I've done 4 episodes on indexes.
Which now brings us to the second thing that allows us to do as investors, because if we find a product that we can just continually invest in over time, and the structure of that product is designed to be timeless, to give us more of the good and less of the bad. It means we don't have to make as many investment decisions, don't have to do as much analysis and as much thinking. We can not only dollar cost average, but we can automate that dollar cost averaging, and we can build a habit, an automatic investment habit that just every time we get paid or however we get money, you automatically transfer it into your brokerage and buy some of these ETFs, and it just can take all of the thinking and all of the procrastination and all of the reasons to not invest out of the process.
Yeah. Which then leads us to the third point, which is by doing those two things, we can then not feel like checking our investments regularly and just get on with life.
Yeah, and that the ability to not check your investments regularly comes from the confidence in what you're investing in, and knowing that it's something that's designed to be truly long term.
Yeah.
And so what we can do is we can invest regularly, we can automate it, we can stop checking our investments regularly. What we have got to is a truly set and forget investment strategy.
Yeah. Yeah.
You can set up your investments and get on with your life, which was the tagline for our second book.
Yes. And it all comes down to the way these products are built. So I think, this for us is just, for a lot of people, it is the ultimate long-term investing strategy.
Yeah.
You don't need to be, You don't need to have a degree in finance. You don't need to be educated in investing. You don't need to worry about what stocks to pick, when to sell, checking your investments when markets are crashing, feeling stressed and emotional. For us, these index products are just the way to avoid all of that and still build wealth successfully over a very long period of time.
Yeah. And whichever companies do well, whichever technologies emerge, whichever business models disrupt and take market share, as long as those companies are publicly listed, they will grow and make it into the index and make it into your portfolio, and you will benefit from whatever they're doing and whatever they're bringing to market. And that's the thing that should help you sleep at night and be confident and comfortable, is that you're not relying on an active manager to decide they like that, or you're not relying on your own analysis and your own information flows to find that company. The design of the product captures it all.
Yeah. Now we're going to bring in an expert. Her name is Gemma Dayle. She's the Director, SMSF and Investor Behaviour at Nabtrade, to understand how Aussies are investing and what they're buying. Let's bring her in. So we're here with Gemma Dayle, Director, SMSF and Investor Behaviour at Nabtrade. Gemma, welcome back to Equity Mates.
Thank you so much for having me.
We're closing out our series on the beauty of index investing and how it is such a timeless form of investing. What are your key elements to bottom drawer investing?
Such a cool question, because frankly, the vast majority of people come to investing all excited about doing something dramatic and getting the 100-bagger and all this kind of business. And then after a while, you're like, oh, do you know what? I don't need that kind of stress in my life.
Yes.
I just want something that I can put away, and I know it's going to last me a long time, and it's sleep at night. We use that kind of terminology all the time. But I can just do this and I'm very confident it will work. Sometimes it'll suck a little bit, but most of the time it's going to work for me. So the key features of that are always going to be diversification. If you are young and the audience of this podcast is young, that consistency of coming to market and putting some money to work. I think the biggest challenge for many people is just getting the money in there in the first place, making the decision, putting it to work, because bottom drawer investing is not cash. And there will always be a cohort of people who think it is cash or term deposits or something very safe. That is too safe if you are young, right? So bottom drawer investing, you have to have some money at risk. You want to be putting your money to work consistently. Hopefully you have enough of a cash flow surplus that you can do that regularly, and you want to be building it over time. We're talking about index ETFs, and they are the solution for so many people. It's been absolutely fascinating to watch how they've gone from being a niche product that people want to understand more about to the solution for the vast majority of our new investors and a lot of our more mature investors as well. They solve so many of those problems.
Yeah. Love it.
So at Nabtrade, you have a wealth of data at your fingertips on how Australians are investing. And so we really want to understand, I guess, some trends that you're seeing in investing generally, but specifically around some of these index funds that we've been talking about in the series. So I guess let's start general and then maybe we can go specific. But what are you seeing in the way that Aussies are buying and selling ETFs?
So the first thing I would say is selling's not a big thing. Right?
Nice.
That's
Oh,
not
good.
a big
That's
thing,
good.
right?
Yeah.
Buying, absolutely. Selling, nah. So the bit that is awesome, right? So when I first started investing, there were index funds. You've mentioned index funds. They were difficult to access. You had to get a paper-based PDF back then. You had to, fill out 247 pages of personal details, send it off to someone. There were 5-day turnaround times to get invested and so on. Now it's, make a decision, execute it on your phone. It's not challenging, and I think that is superb. And it has just dramatically changed the way people do things. But the evolution, even over the last 5 years, has been really extraordinary. So 5 years ago, pre-COVID particularly, because our customer base has doubled in 5 years, which gives you an idea of just how many people have come to market. There was obviously a massive pull-forward effect in COVID, right? We saw the number of new applications for people opening an account 3, 4, 5 times on a daily basis, right? Everyone was opening an account. If you didn't have one, you got one then, right? So no one's doing it now because you've already got one. You got it during COVID, unless you just turned 18. Sorry. But for the vast majority of people, that was your window. And so we went from seeing ETFs as a product that people used. They were about 4% of holdings prior to COVID to being a top 10 buy during COVID and a consistent top 10 buy now. So it wasn't just a COVID phenomenon. And there's probably two parts to it. One is, are people buying them because they want to put money to work but they're not sure what else to buy? So the market's fallen dramatically. I just want to go. I want to get in. I don't have time to make a decision. I don't know what's fallen enough yet. I haven't got myself set, but this is a great answer for me. And I personally did this during COVID on the worst day, that mental day when the market fell, 8% and then closed up 4%. That was the day that I just chucked a ton of money at ETFs, right? So I'm not trying to pick any stocks now. I just want it working. So there's a good amount of that happening, but there is also the bottom drawer investing component, which is people who've gone, I don't ever want to make a decision about what stock I'm going to buy. I am just going to put my money to work, and they will tend to buy the ASX 200 and then they will consider diversifying internationally, which I find fascinating. It's a consistent trend, and it is not just young people, but young people are somewhere between 3 and 4 times more likely to hold ETFs than older people. That's mostly because older people already have a portfolio and they don't want to have to sell
them. Their
them.
portfolio is essentially an ETF.
We do have more than one investor who could probably just aggregate.
Yeah, exactly.
They're not paying an MER. I mean, that's the only thing you can say. But at 4 or 5 basis points, well, their allocations might be a bit out of whack. So we see that. And so now they're more than 10% of holdings, probably even higher than that now.
Wow.
And they are growing and growing and growing, and they're absolutely top 10 buy at all times. It's amazing.
Well, that's just really positive to hear. Having done this podcast for so long, and that's the message that we try to get across. Like, you're right. If you want to take advantage of a dip in the market and you don't have yourself set or have those opportunities ready on paper to jump in, there's nothing wrong with just putting a bit of spare cash into these broad-based indexes.
Although I think you've now given us our next focus area, which is home country bias.
We have a bit of that. When I say a bit, like enormous issue.
Yeah.
We've always wondered, it's very relevant for older investors. Again, if you're a retiree, home country bias makes a lot of sense in Australia because our dividends are so high. You've got the benefits of franking and so on. And our investors are just so attuned to that. They are so familiar with it. The concept of going to the US, taking currency risk and getting a 1% yield is not just foreign, it's like abhorrent to Australia. Australian retirees are like, that's rubbish. I don't care how much growth I'm getting. There's no point doing that. I'm going to have to sell down regularly. It sucks. Whereas younger investors, that is the kind of risk you can afford to take. You don't need the yield. Franking is lovely, but it's not super important to you in the same way it is an older person. So to my mind, there should be a fairly dramatic generational shift toward more international investing from younger investors, but we see how that goes.
How are you interested to know the dynamic between these timeless core index-based funds that we've spent the last 4 episodes talking about, but then like the thematics? How are you saying, is there a difference in behaviour when it comes to the two? Because there's just so many coming to market at the moment.
So we get this question all the time. As I said, ASX 200, ETFs, way out in front by the most dramatic margin. It's hard to overstate it. Huge gap. International.
Yep.
Even bigger gap. Thematic.
Wow. Okay.
They are teeny, tiny. And I can only assume that is because investors fully understand the value of diversification. They know when they go thematic that you're diversified in a tiny universe. You've already taken a fairly significant bet. It's a niche, and that's fine if you want to put some money to work in that niche. But for the vast majority of people who are using ETFs and using them consistently, so one data point I didn't say earlier, 25% of our young investors only hold ETFs.
Oh, nice.
That's all they hold. Wow. And they are primarily broad-based market ETFs, right? They're not niche at all. That's not what they're looking for. They're just trying to build this beautiful long-term growth portfolio that they can retire early or whatever the goal is. That's what they want. I think in many cases you don't even have a goal. You just want to put the money to work, right? This is where you're trying to go. And so the niche opportunities, we don't see a lot of appetite at all.
Yeah.
It's occasional. Like we do see them in the numbers, obviously, but also they change over time.
Yeah.
So it was all about lithium and battery tech a little while ago,
Well,
and
that's
now
the
it's
thing.
not.
They're just not bottom drawer core.
No.
Like you shouldn't think of them like that. So
I think
it's also positive that behaviour is reflected.
I think also people are far more well-educated and far more astute than anyone in the media gives them credit for, and the average person on the street gives them credit for, which is most people know to have a little look under the hood. Like they're not going to just buy on the name, and they'll be like, oh, I just bought this robotics ETF, which is very much the top 10 of the NASDAQ.
Yeah.
Could just buy the NASDAQ. I mean, that would be sort of a broader solution for me. And when I look at lithium or whatever the other thing is, a little look under the hood, I can see the fees that I'm paying, and I can see just how narrow the concentration is in this tiny space. Maybe I don't need that.
Yeah.
So they'll take it as a little punt here and there, but they're very much in the niche space, and they're very much a punt. People are building out a core portfolio. That is almost exclusively what they're looking for.
Yeah. Well, Gemma, this has been a very reassuring conversation, and it makes me think maybe we didn't need to do a 4-part series on the beauty of index ETFs,
we do.
because so many Australians are already investing that way. You know, they're dollar cost averaging, or they're like, maybe they're trying to invest a little bit more when the market's falling, but they're investing consistently. They're buying these index products rather than, thematic ETFs. Anything else that you're seeing from Aussie investors that's worth noting, or should we just leave this feling very
all good
positive
to
about?
Yeah.
We can all go home now. It's fine.
Well, we've done our job.
I do actually, clearly what you're doing is working, right? And it's amazing how effective the education campaign has been around this, right? That's the most extraordinary thing. People are always complaining about financial literacy in this country. But when I look at our data, and it is many, many hundreds of thousands of people, this is not a tiny data set. We all did stats at uni. We know how it works. This is a huge data set, and it tells you that people are making really, really good decisions, like really high quality decisions. The one thing that I didn't mention, which I find fascinating though, is they do understand dollar cost averaging. They absolutely will buy the market when it is cheaper. Not cheap necessarily, because obviously you can wait a long, long time and the market doesn't get cheap. But whenever futures are down and we know there's going to be a rough day on the ASX, we will see a big spike in buying. And I love that. That's happening all the time. And it's harder to time, obviously, with US markets because you've got to take currency into consideration. But we see it on the ASX. Every single day that the futures is off more than 0.5%, let's say, we will see a big spike in ETF buying. I am trusting that is because people know it's a better time to buy when the futures are up 1.5, right?
Yeah.
I'm assuming that's what it is. But it does give you a guide to how astute people are, right? It's not just set and forget. They are trying to time just to get that little bit extra.
Little advantage, yeah. Love it. Well, Gemma, thank you so much. It was great to have you back on Equity Mates, and it's great to hear that so many of Nabtrade customers, and I imagine so many of the Equity Mates community, are investing in a timeless manner as well. So love it. Thank you so much.
Thank you so much.
Now, we'd like to thank iShares by BlackRock, Nabtrade and S&P Dow Jones Indices for supporting this series. If you're looking to invest in ETFs but not sure where to get started, visit blackrock.com.au/iShares for information about the iShares ETF range available in Australia, or visit nabtrade.com.au to explore further insights, education and tips for getting started with ETFs.
S&P Dow Jones Indices does not sponsor, endorse, sell or promote any product based on an S&P Dow Jones index, nor does it make any representation regarding the advisability of investing in the products. Before making any investment decisions, you should assess whether the product or service is appropriate for you and read the PDS and TMD available at blackrock.com.au.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.